Hey you guys, welcome to Young Money Investments. In today's video, I'm going to be giving you my top 20 tips in order to become amazing at day trading. I'm not talking about just being regular. I'm talking about being an amazing day trader. If you want to learn my top tips, stick around for the whole entire video. You're not going to want to miss the 20th tip. Check it out all today on Young Money Investments. All right, you guys, it has been a minute since I talked about some of my top tips, tricks, and strategies for being an amazing day trader. Now, I got to give credit to my boy Corey Mitchell over there at The Balance. He has helped and written a lot of these tips, tricks, and things, so I'm not taking all this credit for it, but I want to give you my insight as well as a day trader, as a as a trader in the markets for over 10 years now, starting off when I was freaking 26 years old. No, starting off when I was 16 years old back in high school. It's crazy how fast time has flown. Rule number 1, create a trading plan. Before a single real dollar is put at risk, a trader needs to have some idea of how they will make a profit. The steps that will be taken in order to attain those potential profits are laid out in a trading plan. A trading plan is a personally written document that states what we will trade and when, how we will enter a trade and why, when and how we will get out of winning and losing trades, and how we will determine our position size. These are the basics. Additional rules can be added over time as needed. As my mom always said, when you fail to plan, you plan to fail. Trading plans are crucial because emotions are the enemy of profiting in the stock market. If you have a plan, if you have it written out, if you have automatic set alerts that you trade off of, and you did it based off of homework from previous analysis before crazy thoughts were going through your head, you're going to be so much better off. Número dos. Prove your methods before you trade real money. With a trading plan in place, the next task is to test that plan in a demo account. No real money is at risk to see how it performs. If the plan doesn't work in a demo account, it won't work in the real world. Revise the trading plan and then go to the demo account to test out the changes. This process continues until a profit has been made for several months in a row. At that point, it is likely the trading plan is a good one. The following tips will help you get your trading plan to that point. Now, one of the things with that though is trading in a paper trading account works for some people, and for other people, it just doesn't work. For me personally, I am not the greatest of paper traders. I don't love it because it doesn't have the same raw emotion that comes from trading real money. What I would also kind of substitute this rule with is if you don't feel the emotion during paper trading and you trade with massive size that you normally wouldn't be able to in real life, trade with a smaller amount. Trade with an amount of money that doesn't really matter to you, but it matters to you. Do you know what I'm saying? Trade with an amount of money that will hurt a little bit if you do lose it, but it won't make or force you to not be able to pay your bills if you lose that money in the stock market. Rule number 3, create a day trading routine to avoid mistakes. Create a routine for the trading day. A routine includes getting up at the same time each day, starting to trade at the same time each day, and checking for scheduled economic data releases that may affect the market. Quit trading at the same time each day and have a routine for reviewing all trades taken. In terms of each trade, have a checklist you run through to make sure that each trade aligns with your trading plan. I know traders that trade in the pre-market hours. I know traders that only trade for the first 30 minutes or hour of the day. I know traders like me that sometimes get stuck there and watch the charts all dang day. Now, while I don't recommend that, and I do like the idea of trading just the morning hours, the biggest times for movement is going to be the very first hour of the day and the very last hour of the day. Most of the time, if you're a consistent, profitable day trader, you really only need to trade the beginning of the day and the end of the day. If you're like me and you manage a private mentorship group, you're going to trade the whole day though. You got to help the students and be available. And quick plug, my private mentorship link is down below. If you want to get more of a personal one-on-one interaction with me, know when I am buying, selling, and any of my call outs that I'm posting, that link is down below, and it's super inexpensive, you guys, for the help that you get. It's an insane value. I'd love to see you down below. Click on it. Let me know if you have any more questions. And that's just a quick little plug. Number 4, don't hold positions during high impact news announcements. High impact news releases are unpredictable in both how far they may push the price and in what direction. High impact news events include company earnings, announcements, and scheduled economic data releases. Avoid holding day trading positions during such events. Instead, wait till after the news is released, then use day trading strategies to capitalize on the volatility that ensues. As I always say, trade the trend. A lot of traders, including myself, have tried and failed trading earnings releases. Sometimes you think that a company is going to go up, but so did everyone else the week before. And even when the company releases positive earnings, the company tanks. There are also times where the company goes below expectations. It doesn't do as well, and for some reason the company still rips. These are movements you just can't control, and I for one am not a trader that trades based off of risk. I'm a trader that trades off of profitability, and thus you are too. So don't roll the dice on any trade that you're taking. Always take the safe route. If you're really feeling risky, try it once or twice, but you're gonna find out that more often than not, it doesn't play out in your favor. And if it has worked for you, I'd love to know down below. Please comment, because I can be wrong sometimes, but I want to know down below. And number 5, review trades weekly and monthly. A review is critical to long-term success. Without review sessions, a trader can't see the overall picture of what they are doing well and what they are doing poorly. Each day, take a screenshot of your chart with all your trades marked on it. At the end of the week, review the charts for the prior week and note deviations from the trading plan. Note any areas of the trading plan that could be improved. Write down a plan for how to implement these improvements. At the end of each month, review your weekly plans and note whether you have made any progress on these or not. I cannot stress the importance of following a daily plan, weekly plan, and monthly plan. Always tracking your trades and looking at your data will be the key to your success. Number 6, create a mental checklist that each trade must satisfy. When watching a price chart, it is easy to get distracted from the trading plan. Prepare a checklist to run through before every trade. The checklist must make sure that the trade meets all the specifications laid out in the trading plan. It only takes a second to mentally go over the checklist and can save a trader from many bad trades. I always love using the charts on TD Ameritrade's Thinkorswim platform and setting alerts, creating support and resistance, and having that mapped out before I enter the trade. Number 7, have a plan for when your weaknesses pop up. And trust me, they will pop up. Each trader has weaknesses and strengths. Over time, a trader will notice their weaknesses, such as not taking a loss when they should and letting it get bigger. That happens to us all. Or taking trades that don't align with the trading plan. And thus, these trades are based on an unproven strategy. Such weaknesses can cause big losses in a hurry. Have a personal plan for what you will do when you notice yourself making one of these mistakes. The plan may include closing the trade immediately, followed by a mandatory 10-minute break. The plan may include closing the trade immediately, followed by a mandatory 10-minute trading break. Or it may even include hiring and asking a friend to work with you on the issue until the weakness is eliminated. That's one of the reasons, honestly and truly, I think a private mentorship and a private group, a paid group, is so helpful and beneficial. How many of us have been in a private group that is free? What happens, you post that you took a loss and everyone else posts, yeah, I lost this much, yeah, I lost this much. And then another guy goes, well, I made $5,000. And everyone then focuses on the win. Or vice versa, or someone else says they took a loss and everyone focuses on them. The thing about a paid private group is they care about your success. These people are there, they have a vested interest in you, your well-being, and what's happening in your accounts. And that's one of the reasons I created Young Money Investments Private Mentorship. That's what it's for. Number 8, utilize a stop loss. And it doesn't have to be a physical stop loss, it can be a mental stop loss as well. A stop loss order gets a trader out of a trade if the price or asset doesn't move in the expected direction. It is the point where a trader must admit that they are wrong. It is impossible to predict what the market will do from moment to moment with great accuracy. Therefore, losing trades do occur. The stop loss protects the trader from bigger losses during those times. Use a stop loss. I can't talk about managing risk enough, and managing risk using stop losses, even mental stop losses, is one of the most critical, important things that you can do as a day trader. Now, number 9 in the article was risk less than 1% of capital per trade. I disagree with that. I usually like to have a 3x potential for profit versus my loss. You're not always going to be right. You're not always going to nail it within 1%. That is unreal and unrealistic, especially when you're day trading. And to have a 1% margin of loss, you're going to lose on a lot more trades than you're going to profit. And sometimes those drop below and then they end up bouncing back. So going with the 1% rule is not something that I would recommend. I would recommend having at least a 3 times percent for profit versus what your downside risk is and where you need to get out in that stop loss. Honestly, forget number 10. It's not really that important. Honestly and truly, number 11 isn't that important either. Let's skip past that, get to number 12. Number 12 is critical. Potential reward should outweigh risk on every single trade. Overall profit is determined by what percentage of our trades we win, our average winning amount versus the average loss. Day traders should strive to have an average winning trades that are bigger than their average trading loss. That means only trades that where the target has a reasonable chance of being hit and can be placed at a further distance from the entry point than the stop loss. For example, if the stop loss is 10 cents away from the entry, then the target is 20 cents away in this case. The potential reward is twice the risk. I always recommend having at least a 3x. Not a 2x. Number 13, implement a daily stop loss. I know, Cameron, you're going, why? Well, let's talk about it. Just as a day trader should control risk on each side with a stop loss, a trader should always cap how much they are willing to lose in a single day. This is for mental sanity purposes, and I promise you it will help you out in the long run. Bad trading days happen. We can't let those days ruin our entire month or account. Limit single day losses to an amount that you can reasonably make back on a profitable day. New traders who don't know how much they can make on a profitable day should limit single day losses to 3% of their account balance, and I disagree with that. You need to give a little bit more room, but do it within reason. Use limit orders when entering positions. Now, I agree and disagree with this. There are times where you need to market order in, and that's where you need a good direct access broker, or a broker that is not going to allow a lot of slippage, where your position entry is far off from what the current ask or bid is when you're trying to buy on the bid or sell on the ask if you're shorting. A limit order will only execute the price specified or better. Entering a trade, we use limit orders to control at what price we will enter the trade. If you use market orders, we may end up with a different price than expected, which may throw off our whole entire plan for that trade. That especially happens in Robinhood, and so I would recommend not day trading on Robinhood ever, or even using Robinhood. But for that matter, I would always, most of the time, recommend using a limit order to get in or out. But sometimes you do have to market order in and out. It just happens. But most of the time, limit order is the way to go. Trade at the same time each day. We already talked about this, but let's talk about it a little bit more. Markets have different tendencies at different times of the day. There's more volume in the mornings and more volume in the last hour than there is in the middle during especially lunchtime, which is called zombie hour. The most efficient approach to day trading is to implement strategies that work well at certain times of the day, and then only trade during those times. Number 16, and this is a hard one to agree with. I agree with it, but I don't practice it, and that is focus on one market at a time. Some traders feel a compulsion to trade anything that is moving. Don't do that. I don't do that. Don't do that either. These traders typically end up mastering nothing. Focus on one market, even one specific instrument such as one stock, Forex pair, or ETF, and become a master in it. Becoming a master in one thing will produce far more consistent results than being poor at trading a bunch of different things. That's why I recommended in my previous video to focus on futures trading. You don't need to worry about PDT. You can trade with a much more leverage and margin account than you could if you're just trading some other commodity like a stock or equity like the stock market. This is a great option. Futures trading is really a great strategy, especially for new traders that are wanting to get into day trading. Check out my last video. There's a link down below in the description, or it should pop up here as well. Check it out. Or it'll pop up at the very end of the video. Even better, that's where you're gonna find it. End of the video, you can click on that and you can watch it. It's super good, I promise. But for real, it really is. It really is good. I worked my butt off to make that video, I promise. I put in like all day and night to like put in the information for that. Let's keep going. Number 17, and something that I wish I knew so much sooner. Price action is more important than any indicator. How an asset's price is moving is more important than what an indicator is saying. Most technical indicators look at historical prices and therefore can't tell you what is happening right now, while the actual price can. This isn't to say technical indicators can't be used, but they should be used sparingly. Number 18, don't let one mistake turn into more. And this can happen to anyone. Trading mistakes happen. They are annoying, usually cost some money, but won't prevent you from being a profitable trader if you put a lid on the mistake right away. Don't let it fester, bother, or cause you to make more mistakes. It can easily happen to anyone, and you really do need to get really good at doing this. Accept that mistakes happen and then move your focus back to implementing your strategy. Our goal should always be to trade another day. If we let the mistake get us angry, that causes us to make more mistakes. We could lose a lot of money in a hurry. Number 19 is so crucial and so important, and that is avoid distractions like newscasts or analysts' opinions. Those talking heads on CNBC, more often than not, are wrong. They are just a distraction. A day trader's job is to implement a strategy that works over and over and over again, as conditions allow. Outside input won't aid in this endeavor, but may cause us to deviate from a profitable strategy we are already using. If we have a strategy that works, there is little reason to listen to others' opinions on the market, except for when engaging in polite conversation. Polite, not troll rants and rages that sometimes happen in my comments section. And number 20 is super important. Trust yourself, trust your research, and the practice that you've put in. New traders often get stuck in an endless search for more knowledge, reading one book after another, watching video after video, and jumping from this guru to that guru. Realize that all this extra knowledge won't necessarily improve results. You only need to implement one strategy effectively to make a profit. Once you're doing that, trust yourself. After all, it is your money. While I agree with this, I also disagree with this, and I think that it is important to not be a one-trick pony. If you stop researching, stop learning, stop practicing and trying to learn what works, you may never find the strategy that will work for you. If I had to give one tip, one specific thing, I would say always manage your risk. Do not ever put your account in enough risk or jeopardy that it determines how you feel and your ability to go back to trading the following day. If you can do these 20 things, you are on your way to becoming a profitable and successful day trader. I'd love to know down below, what are some suggestions that have helped you in order to become profitable or be successful in the stock market? Again, I hope you found this video helpful. Please comment down below what you've liked, and please like, subscribe, and turn on that bell notification. And if you have not followed me on Instagram already, there's always some interesting good stories. Get to know me on a personal basis over on Instagram at Young Money Investments. And I cannot wait to catch you in the next video as we cover more interesting investment topics, keeping you young money, not dumb money, all here on Young Money Investments. Talk to you later, guys.